Welcome to week 6 of my Saturday series tracking Nifty's full week journey. I am Prakash Choudhary, an NSM certified research analyst. Today, we are breaking down the exact numbers, the sector performances, and the 7 critical policy updates for this week that you need to know for Monday morning. Let's dive in. 1. On April 20, the RBI partially rolled back its April 1 directive that had barred banks from offering rupee linked non deliverable forwards, NDFs, the most widely used tools for offshore rupee trading. It also lifted restrictions on rebooking cancelled forward contracts. These measures had helped the rupee recover and stabilize. Some safeguards remain in place for related party transactions. The RBI is sending a signal to the world. The crisis is over and the rupee is stable. By removing these emergency restrictions, they are making the Indian financial market look more normal and attractive to global investors again, while keeping just enough control to step back in if oil prices or conflicts flare up again. 2. On April 24, SEBI introduced a netting facility for foreign portfolio investors, allowing them to settle the net difference of same-day cash market trades instead of processing each transaction individually. Previously, if an investor bought and sold shares of the same company, they had to provide full cash and delivery for both legs separately. By settling only the net balance, FPI significantly reduced their ideal cash requirements and lower overall funding costs. This structural shift is particularly vital for high volume index rebalancing days, where massive capital flows occur simultaneously. Ultimately, this reform enhances operational efficiencies and ensure the plumbing of Indian stock market runs smoother for global participants. 3. The NSE's long delayed IPO is nearing reality after a SEBI expert panel cleared a record 1,880 crore settlement proposal for the co-location and dark fiber cases. This consent order allows the exchange to resolve the long-standing legal scandal without admitting guilt, potentially ending years of regulatory deadlock. As the largest settlement in the Indian market history, this move effectively clears the primary roadblock preventing the exchange from going public. If the SEBI board grants final approval, the world's largest derivative exchange can finally proceed with its highly anticipated listing. 4. The RBI is in strict parent mode, slapping Bandhan Bank with a 41.8 lakh rupees fine to signal that KYC and regulatory compliance are now non-negotiable. Simultaneously, new rules requiring 100% collateral for bank to broker lending are cutting off easy money for big trading desks. For you, this means stock trading might get slightly more expensive due to less market cushion and wider price gaps. For your portfolio, it's time to favor banks with spotless records over those just chasing rapid growth. 5. SEBI in its regulatory velocity phase is cracking down on high-speed ghost orders by tightening the order-to-trade ratio to limit excessive noise in the F&O segment. By penalizing high-frequency traders who flood the system with orders they don't intend to fill, the regulators aim to cool down the risky retail frenzy. For traders, this means the speed advantage of algorithms is being taxed, leading to a more level playing field. For long-term investors, these rules act as a safety net, reducing the risk of sudden flash crashes caused by out-of-control computer programs. 6. To manage national finances, the Indian government just auctioned off rupees 32,000 crores in bonds ranging from short-term debt to long-term green bonds. However, this massive supply of government paper is keeping bond yields high, which often puts pressure on the valuations of high-growth tech stocks. 7. Meanwhile, the ongoing US-Iran tensions have kept oil prices volatile and unpredictable. This oil stress is direct hit to companies who face higher raw material costs and OMCs, who see their profit margins squeezed. For investors, this suggests a sectoral rotation away from energy-dependent industries until prices stabilizes. Ultimately, the government is balancing the need to fund its project while navigating a tricky global environment that threatens domestic inflation. Key macro trigger to watch: the India-US trade deals remains unsigned after months of negotiations, with the Iran war pulling diplomatic bandwidth toward energy security and geopolitical crisis management, a delay that could stall trade talks further. A signed deal, when it comes, remains the single biggest potential positive catalyst for Indian markets in 2026. Before we move on to weekly stats, don't forget to subscribe our channel Market Insights by Prakash. Weekly stats. The Nifty 50 lost 1.9% and the Sensex dropped 2.3% in the week ending 24 April. With weak IT sector earnings, high crude oil prices, FII outflows, and a weaker rupee weighing in on sentiments. HCL Tech lost 16.6%, Infosys 12.4%, SBI Life 10.2%, Tech Mahindra 10.1%, and TCS 7% in a single week. On the positive side, OFFS gained 12%, Hitachi Energy rose 11.3%, GE Vernova gained 11.1%, Nestle 10.39%, and AU Smile Finance Bank was up 7.6%. FII sold approximately 17,140 crores. Sectorally, top of outperformers this week were FMCG, media, and pharma. Money aggressively rotated into these pockets as the week progressed. The clear laggard for this week were IT, auto, consumer durable, private banks, realty and metal, oil and gas, PSU banks, and chemicals. So, how do we trade this data? The India US trade deal is your buy everything signal. Until that ink is dry or oil stabilizes below $100, keep your cash levels slightly higher than usual to capitalize on sudden flash crashes caused by geopolitical headlines. For long term investors, the strategy must be selective accumulation. Do not catch the falling knife in the IT sector, wait for base to form. Focus on defensive sectors like FMCG and pharma. Watch for quality bank stocks with clean books and robust numbers. For swing traders, keep an eye out for the buy the dip setups and breakouts. Strategy is to be selective in this market. For FNO traders, with the monthly expiry coming up and VIX spike up to 19.71, and with high premiums and new collateral rules limiting liquidity, skip naked buying. Focus on Iron Condors or bear put spreads to manage risk against flash crash volatility. Now, here is my question for you heading into week 7. With this increased volatility and FIS selling back in action, do you think Nifty will be able to hold 23,500 mark effortlessly or rebound back after filling the back to 24,500 mark next week? Drop your Nifty targets in the comments below. Let's see who nails it. If this weekly Nifty deep dive helped you connect the dots and prepare for Monday, hit the like button, share it with your trading community, and make sure you are subscribed to Market Insights by Prakash. Catch you next Saturday. Thank you.